Hi, good afternoon, everyone. Welcome to joining our market outlook section for fourth quarter 2024. All right, okay. Thank you very much for your time. Currently, we are experiencing some technical difficulties. Please bear with us. Okay, for a few minutes, we will be on shortly. Okay. Yep.
Okay, good luck. Okay, great. Hope you all can hear me. Right. Okay. Sorry about the technical issues that we were facing. But okay, we hope that it's been resolved and we can get on with our presentation for this evening. Once again, thank you very much for joining us. My name is Victor. I am the head of research of Indo-Pacific Research Sindram Berhad. Today, we are going to present to you our fourth quarter 2024 economic and market updates. As you can see by the title, volatility is within us right now. But overall, I think the undertone should stay firm up to the rest of this year. Right. So let us get it started with a little bit of a disclaimer here, which is very much self-explanatory. And moving on would be the agenda that or the subjects I'll be talking about for today. Simply, I'll start off with the very quickly on the global and Malaysian economic review. As you can see in the second quarter of this year, it was still outperforming. Then we will go into the economic outlook. Conditions still look very mixed, and then there are some signs of moderation. But on the equity market, in the third quarter of this year, obviously there were some steep bumps, which I will explain later on. But overall, it still made very decent headway the third quarter. So on the outlook side, I would still think that volatility is still a feature, and it could temper the upside. But as I said, much of the gains will be preserved as we move along. So finally, my colleagues will present to you our stock picks before LT will present to you some of our technical ideas that we have for this upcoming quarter. Right. So very quickly, let us look at the global economic review. So in the second quarter, for the most part, I think, as I said earlier, the global economy actually stayed fairly resilient and again sustain much of their growth that was attained in the first quarter of this year. And of course, a lot of it, if you look at the table from the page, you'll see most of it is actually contributed by US, Asian, and some European countries. So for the most part, I think Europe is still very weak, and most of it actually came from the US and Asian economies. But overall, if you look at it, the improvements were quite incremental, and as I said, it's very varied. And then it's very much driven by increased consumer spending as inflation continues to ease further. So overall, employment conditions were very much on the firm side, and that, of course, helped to support global growth in the second quarter of the year. Now, looking at the global PMIs, you can see that actually this is not up to June. It's actually up to sorry, the middle of this year. Sorry, correct. So, global industrial and services segment were, if you look at the chart, is basically quite flattish. You can see that the red line, which is the manufacturing sector, is practically hovering uh, with very minimal growth or minimal contractions for much of the quarter. So all of this, the growth in the global PMIs is basically supported by the services industry. And even that, if you look at individual countries, the performances were very varied. Uh, Manufacturing activities remain very subdued in the US and Europe on the back of weak demand. But over in Asia, there were combination of firmer external demand as well as domestic demand that actually helped the manufacturing sector for many Asian countries to remain on the upside. Here we're talking about places like South Korea, Taiwan, and certainly Vietnam. On the services side, growth was actually still very much in in firm demand, and this is mainly very much on services like restaurants and what have you, uh, very much so in the US and in Europe. So growth was on that part that offset the still very weak manufacturing activities in the US and in Europe respectively. Right. So that was a very quick review on the economic conditions in Europe and in the US. Now let us move on to the Malaysian side. We had a very strong second quarter performance this year, and if you look at it, uh, GDP growth on a year-on-year basis was actually 5.9%. So it is one of the highest in the past year or so, and of course, it's very much supported by favorable export performance. Uh, Household spending remained very strong, and then there's a lot of business investments as well, and of course, all this led to stronger domestic spending. So household spending as a whole improved by about 6%, imports about 8.4%, and private investment was very strong on 12% growth lah. So here a lot of it is actually on investments into data centers, and in the manufacturing sector as well as the services sector lah. So all this was actually also very much on the back of the stronger policy support. Or in other words, government support, investments into the AI segment in tandem with the global um, recovery of the E&E sector as well as domestically a lot of tourist arrivals. So collectively, all this actually led to the stronger growth in the Malaysian economy. That's very much on the demand side. On the supply side, expansion were very much broad based. In fact, all the sectors recorded growth compared to the first quarter of this year. Steady growth was very much seen in the services sector, and of course, much of it were from the wholesale and retail trade subsector, which grew almost 6%. As I said, the plethora of demand for AI related peripherals actually helped to see some positive progress in the manufacturing sector. So it actually grew about almost 5% on a year-to-year basis. If you compare that growth to the first quarter, it was only about 2%. So a lot of it was on goods, export goods, that actually posted a 5.5% growth in the second quarter compared to only 1% in the first quarter of this year. So as you can see from the chart, you can see the red line continues to be on the ascent, but notwithstanding the slight downtrend in the first in June, but overall conditions have actually much improved compared to, let's say, uh, uh, 12 to 18 months ago when exports were in contraction. So as a result of it, the other indices like the manufacturing sales and industrial production continues to be on a slight uptrend. If you look at the on the chart line, so you can see that there is improvements on a gradual pace, and that is actually helping the Malaysian economy to post stronger growth as well. Right. On the domestic side, domestic demand actually grew very strongly, about 6.9% year on year. As I said earlier, private consumption was up 6%. It actually helped a lot of the jump in domestic demand now. The final consumption is expenditure is also up by about 5.6% compared to 5.1% in the previous quarter. In terms of investment, it improved very strongly by 11.5%. Uh, if you compare that in the first quarter, it only grew by just a hair below the 10% level. So a lot of it actually came into the structure side. In other words, things like data centers and other infrastructure. So as a result of it, you can see that the construction sector posted a very strong growth of about 17.3%, surpassing what was achieved in the first quarter of this year. All in all, the current account surplus came in at 3 billion. That is actually lower than the 16.2 billion recorded in the first quarter of this year. Uh, it should be unduly concerning as much of the trade surplus, reduced trade surplus was due to higher travel, transportation, and other business services. So that took out a chunk of the current account surplus. And of course, that also offset the wider primary income deficit and export trend. Overall, CPI is around 2% for the quarter, um, just slightly higher than the first quarter of this year due to higher housing and utility costs. Okay, so again, that's a very quick review of the Malaysian economy. Now, let us move on to the global economic outlook. So, just let me explain the chart first, the table first, sorry. Comparatively, most countries in this chart are seeing increase or relatively unchanged forecast, but they're generally on the uptrend. So that also is seeing some of the 2024 forecast tip higher. But for 2025 at this juncture, most of the consensus estimates are very much still the same. So as you can see that they are in a lot of countries, they are actually much weaker than what they were from 2024. But nevertheless, these are all preliminary forecasts at this stage. But if you look at it, 2024 promises to be slightly better in terms of forecast compared to the previous quarter when I presented this. So, as I said, growth is expected to stay steady heading into the last quarter of this year. And there are, as I said, strengthening slightly with this follows the global economy that actually averted a recession in 2024. The recent Fed interest rate cut, coupled with that from Europe, is giving hope that the growth will be stronger heading into 2024 and early 2025. But mind you that all this sort of interest rate cut will take time to filter into the economy. So it will be some time before the benefits are actually known now. But nevertheless, with inflation still uh, likely to come off further. Therefore, the estimate, at least in the US, is for potentially another 50 basis point cut before the end of the year. So possibly in November and December, 25% basis cuts on each month. So what that means is that the earlier concerns or for the concerns for much of the year of high inflation and the corresponding high interest rates are likely to ease further. So all this could help the global economy to post firmer growth in 2024 as well as in 2025. Coupled with that, there is still a strong labor market conditions, and that should also support consumer spending growth. And at the same time, also right now, most global economies are emerging stronger from the pandemics of the last 2 years and beyond. But there is a rise in new investment that could aid the global economic revival. But having said that, a lot of this pace right now is still tempered by lingering uncertainties. And among the lingering uncertainties that are currently putting an impediment on global growth will be of course, the geopolitical conflicts in the Middle East and between Russia and the Ukraine. And right now, the interest rates are still way above historical averages, and the tightening process is still there. And so with the interest rates remaining high, that could also in a way affect growth for much of the year. And as I mentioned earlier, a lot of this impact of the reduced interest rate will take time to filter into the economy. So in the meantime, you will the public or the economies will have to put up with high interest rates for the next 3 to 6 months. Uh, so far, the consumer spending growth has stayed largely stable. Um, on the back of the strong labor market conditions. But there are signs of softening right now, and wage growth is also slowing. So that is something that could be an impediment to consumer spending growth in the months ahead now. So after well, like I said, the relatively indifferent performance of the global economy in the first half of this year, much of it is likely to persist into the third quarter of this year. Again, as I mentioned earlier, or I should say in the previous quarter, there is a possibility of no landing economic scenario to prevail for the rest of the year. And also at the same time, also the two-speed economic conditions, they also linger. What that means is that certain industries, for example, the services type industry, will continue to do well, whereas others, for example, again, the manufacturing sector will continue to face headwinds in the upcoming months. So, in all, the growth momentum is likely to be on a slow pace for now, even though it's the forecast has been raised very slightly, and all this is mainly because of the easing monetary policies will take time to filter in now. So at the same time, also even the demand dynamics for services type of for services type industries are starting to see some signs of softness at the start of the third quarter and could actually remain tepid for the rest of the year due to the moderating labor market conditions and of course reduce in spending consumer spending growth plan. So what that also translates to is basically both the manufacturing and services sector performances are likely to stay subdued for longer, particularly for the manufacturing side due to the weak demand. But nevertheless, in line with the no landing or two-speed economic conditions, the global recession risk continues to wane. Right now, it's about 30%, coming off from the 50% chance probability of recession that was pervasive for most of the year so far. Lah. So on individual countries, you can expect the U.S. economy to remain very steadfast, and it will continue to anchor global growth with its lower interest rates to also cushion against the potentially weaker employment and spending growth prospects. Over in Europe, economic conditions are likely to stay unsettled. There's still very weak economic undertone in most of its member countries, in particular Germany. But having said that, Asian economies are slowly picking up on the back of their firmer domestic activities, as well as a recovery in overseas demand, particularly for AI related peripherals that will benefit the E&E sector. Lah. So that should be the outlook for the global economies in the months ahead, or at least in the fourth quarter of this year. Lah. On the Malaysian side, uh, conditions should set for further improvements for the rest of the year. This comes after a very strong second quarter performance, and a lot of this will be premised on the continuing upside in domestic activities, and there's a resurgence in exports and of course increasing investments that could push the country's GDP growth to the upper range of the forecast of about 4 to 5% year-on-year target. So if you look at the consensus estimate on the table on the left side, you can see that the real GDP forecast for the full year is already at the upper end of the GDP forecast of 5%. So this comes amid the stronger performances in the first and second quarter of this year. So in the second half of this year, economic upsides will emanate largely from the momentum carrying forward from the first half of this year. So with segments like the services, construction, and manufacturing sectors to actually continue entering growth, riding very much on the improved economic sentiment as well as domestic demand. So there's no change right now. If you look at the table on the left, that there's no change in the overnight policy rate forecast. For the year, it's going to remain at about 3% before potentially falling off to slightly to 2.95 next year. CPI inflation is likely to remain moderate at about 2 to 2.5%, so that is not an issue. As with unemployment rate to be around about 3.2 to 3.4%. So the upcoming budget will actually unveil more about the budget deficit. But the forecast right now is for a 5% budget deficit for the full year. So again, a lot of these numbers are just fine-tuned and little change from the previous forecast. So overall, domestic activities will still continue to anchor the country's prospects in the second half of this year. Overall, the domestic demand is set for growth of anywhere from 5.2 to 5.5% for the full year. There also will be a lot of fresh investments and capex spending estimated to grow at around 5.5% in 2024. So there could be already we're seeing particularly fresh investments into E&E related kind of businesses. Here we're talking about the proliferation of artificial intelligence and into data center. So at the same time also we see a lot of transportation and communication sectors seeing a revival in demand, mainly due to the increased investments. As far as the external sector, there is signs of stronger rebound, mainly on the back of the easing global monetary conditions. However, they do not expect a significant jump at this stage because there is still a lull and the demand may continue to be on a low gear for longer, especially for E&E products. But for non-E&E products, the demand could stay healthy, and this should further support our export growth with the forecast of around 5% growth a year. As far as the manufacturing sector, the growth could actually top about 4.2% year on year. And this is basically on the back of demand for domestic-centric uh, goods as well as non-E&E products, particularly from those in the consumer, transportation, and construction industries. Uh, as far as the employment side, it will still remain fairly strong at about the unemployment rate is, as we said earlier, is going to hover around 3.3 to 3.4%. So with that, it should support consumer spending growth, but and at the same time also supported by higher wage growth. But having said that, the cost of living uh, conditions are actually uh, fairly high at this point, and that may mitigate some of the consumer spending growth. And already the upcoming 2025 budget is likely to see a lot more government incentives towards tackling the high cost of living. And at the same time, also, if on the budget 2025 scheme, there is also talk that it would be very much uh, based on raising government revenue and as well as more government incentives for investments into SMEs and micro SMEs. So that is the general theme at this point. So all this will be reviewed on the this coming Friday. So we'll get to know more on the budget by then. Insofar as risk, of course, it still continues to be what I would say the slower than expected demand recovery from both the domestic and overseas uh, countries. But at the same time, also interest rate cuts that could be an issue if the interest rate cuts much will take longer or less than what was expected. And of course also the lingering geopolitical issues that will continue to affect external demand. So looking at the BNM forecast table on your right, this table has been there for I think about 6 months. So there's so far no change at this point. So we will get a clearer picture on what the sectorial performances will be like when the budget is unveiled uh, at the end of this week. So that's a quick uh, look at the economic side of things. Let us move on to the equity markets. We'll start off first with the global equity markets, and looking at the third quarter of this year, it was very volatile, and even so, the global equities actually saw widespread gains. So if you look at the table, you can see on a quarter-on-quarter change, you can see that except for the Nikkei, most indices in that list uh, has made a very strong up moves. So if you look at it on just specifically on Bursa Malaysia, the FBN KLCI, on quarter and quarter it was up nearly 4%, 3.7 to be exact. And for the year, it's about almost 16% uh, since the start of the year. So by all means, it's very decent. But compared to the rest of the world, if you look at the S&P and the Dow Jones, they are all practically right up to the to new records already. Oh, sorry. Uh, I'm supposed to show you this. Yeah, I'm sorry about that. Right, on this chart, on this table. So as I said, most countries in this, also most indices in this table, in this chart is showing positive growth with the exception of the Nikkei 225. But on the CI itself, it's year to date, it's about 16% change. So it's very decent already. And then if you look at it in the third quarter itself, much of the gains were actually seen on Greater China stocks. Here we're talking about Shanghai and the Hong Kong markets. So in terms of developed countries stock markets, there was a sector rotation from mega cap stocks to smaller caps, and much of this was actually driven by improved market expectations of monetary easing in the second half of this year. But pulling or I should say, contributing to the volatility in most global markets was the fluctuating job data, and of course the uncertainties over the Federal Reserve rate cut, and that contributed to a lot of mixed sector performances. But as I said earlier, bullish sentiments actually flowed into China and Hong Kong equities. This follows the Chinese government's introduction of several boosting measures aimed at pulling its domestic economic growth out of its quagmire that has plagued it for much of the year. Right. Uh, S&P 500 and Dow Jones has actually reached all-time highs again. Obviously, a lot of this came about after the Federal Reserve trimmed their interest rates, and of course, there was a shift from growth stocks to value or defensive stocks in the U.S. stocks in the U.S. stock market. Whereas most European equities in Europe also followed suit, but their gains were much more benign, and a lot of it was concentrated on healthcare, utilities, and real estate sectors. So this, of course, was contributed a lot by the ECB's interest rate cuts that offset some of the weaker demand due to due to lower demand. So, so far as the Asian equities, very solid growth with the Thailand, Hang Seng, and China stocks, the best performing markets. As I said earlier, boosted by China's stimulus measures, of course, and the interest in AI related stocks. So, moving on to the Malaysian equity markets, the after a very strong second quarter, the BMKLCI also remained on the ascent in the third quarter, but the gains were much more modest, even as it tried to make a path at the 1680 level. So among regional indices, the FBMKLCI was the third best performing index after the Thailand Thailand's SEC and the Shanghai Shenzhen Index. So the Malaysian equity market's strong performance continues to be driven by gains from the Federal Reserve um, with the interest rate cuts, which of course boosted the ringgit very strongly. And then, of course, on our own, the very strong GDP performance, at the same time also stronger than expected corporate earnings in selected sectors. But in the third quarter, only a few sectors outperformed after a very strong second quarter performance. And here we're talking about 4 out of 13 sectors that actually recorded gains in the third quarter lah. So the significant outperformers are actually the financial services, construction, and the REIT sectors. In terms of market participation, institutional investors actually reverse their position uh, from net buying to net seller, as with foreign retail players. But overall, foreign buyers were still net buyers during the quarter. Here we're talking about third quarter. But having said that, the daily traded volumes actually eased to about 4.1 billion units per day lah, with the traded values also slowing somewhat by 2.5% on a quarter-to-quarter basis. All right. So moving on to the outlook on the global economy, even though it was a rough start to the fourth quarter of this year, which was mainly affected by the geopolitical issues in the Middle East, that actually, in a way, offset the positive from the start of the Federal Reserve interest rate cycle. So as a result of it, volatility became inevitable, and this is likely to stay remain the case due to the unsettled conditions, and that would of course dictate the equity market's direction in the months ahead. But even though the volatility has increased, overall the global equities market undertone is likely to stay very firm, backed essentially by the sustained economic and corporate earnings performance for the rest of the year, and of course into 2025 lah. Even though that valuations as a whole are still quite pricey lah. So the interest rate cycle is basically is quite timely to cushion some of the softening global macroeconomic conditions. And then, and economic data are still showing signs of weakness moving ahead. So, what will be critical right now will be the further easing of monetary policy for the rest of the year. That should help to cushion some of the geopolitical concerns. And at the same time, also, inflation is continuing to tame, which of course will still remain the main theme in the fourth quarter of this year. So collectively, all this should provide more impetus or more room for global economies to regain traction. And of course, when they do, it will also start to benefit the stock market as well. And then, the investors will start pricing in potentially firmer corporate earnings growth in 2025. So all this would also lead up to that. Uh, so also the expected improvements in corporate fundamentals will actually help to preserve much of the equity market's gains and provide support in the event that there will be stronger profit taking and bouts of correction later in the year, especially when the negative news permeates into the market now. At the same time, also there is likely to be a switch to the broader market shares after the equity markets were actually led higher by mega caps for much of the year. So when that moves to the broader market, obviously is going to result in increased gains for the broader markets as well. But the switch is already happening, and if you look at it, the lagging China equity markets are seeing increased participation as with the rotation into small caps into U.S. markets, and all this is expected to continue for the rest of the year. But having said all of that, I think if you look at the valuation, which I'm going to show you in a while, it's the upside's already, after all the gains that has come forth so far this year, it's already fairly priced in my opinion. So looking ahead, I think any further gains could be quite modest. And then there are also still concerns over the war and the outcome of the U.S. presidential election that could actually slow the path of interest rate normalization, which will still be the main headwind as we speak now. So, like it or not, U.S. equities will still dictate very much of the global equity market's direction, and Asian stocks are likely to follow suit on the back of their sustained fundamentals. But European equities, however, may still continue to lag due to their more subdued economic undertone. So looking at valuations and equity market uh, corporate earnings growth, you can see that if you look at the table, you can see that the MSCI All World Index is actually still way above its historical average of 14 to 16 times forward averages. So with that, I would think that it's already very much reflected the global economy, global equity markets improved outlook. And of course, a lot of this is actually emanating from the overly expensive U.S. markets. And at the same time, also, if you look at Asian equities, a lot of it has also caught up in terms of valuation. So all these are contributing to the increased overvaluation of equities around around the world. So with that, I think upsides would also see very limited growth even up to the end of the year, unless there is a significant change in the fundamentals or easing of geopolitical issues. In terms of corporate earnings, earnings growth have been lifted to about 8.5% year on year globally for 2024. That's an increase from the near 8% year on year growth in our previous estimate. And of course, this follows the firmer than expected first half earnings, and of course the interest rate cuts both in the U.S. and in Europe should provide um, some benefits to help shore up corporate earnings. So, as a measure of how expensive or how overvalued the indices are, so we look at the averages, historical averages of PEs of the both the MSCI All World Index and the S&P 500. So as you can see, they're all tethering well above their historical uh, forward averages now. On the Malaysian side, um, it would seem that Malaysian equities are taking a breather of late, and this is allowing some of the strong gains since the start of this year to be absorbed. And of course, that also meant that the trading pattern is also becoming more directionalist. Right now, there are fewer compelling buying opportunities, low-hanging fruits, for example, after many FDN uh, listed, PLCI listed stocks have already reached fair value vis-a-vis what their prospects are for the next 12 months in a sense. So what is happening right now is that the market is undergoing a consolidation, which of course is also healthy for the key index to take a breather. So as a result of it, market conditions are also likely to stay choppy and unsettled, uh, especially with the ongoing profit taking from foreign funds that look to remain for the time being as some of these foreign funds shift their funds from Asian markets in particular to Greater China stocks in anticipation of more government more Chinese government stimulus on to help the economy lah. So there is a shift there in terms of funds. So as I said, a lot of the positives of this of the Bursa Malaysia stocks have already been reflected in the equity prices. And as a result of it, buying interest has also been noticeably thinner quarter to date. So we expect similar conditions to prevail for now. And of course, any improvements will actually have to be dependent on changes on fundamental changes. So among those that can actually tip the market higher include improving corporate earnings prospects, whatever to be announced by the government in the upcoming budget. Here we're talking about, of course, also new infrastructure developments, in particular the Singapore Johor economic special economic zone, and of course overseas demands from China's economic revival, and of course the pace of U.S. interest rate cuts. So collectively, all this will actually be seen helping to improve the Malaysian corporate fundamentals. So by in doing so, we could actually see more upsides in the months ahead. Uh, Notwithstanding the current volatility, I think what we are seeing right now is existing fundamentals should provide support and help the FDN to continue building up a base and to help them to preserve most of the year-to-date gains. Apart from the typical profit-taking activities, I think the selling pressure is actually still quite light at this moment, and so that should actually provide some support to the market. We are actually encouraged by the base building process, as it could actually provide the impetus towards a potentially stronger year end as the market prices in the continuing improvements in corporate earnings for 2025. And of course, the usual year end window dressing activities. Valuation wise, the valuations are, although they are fair, they are at the lower range of the historical forward averages. So that means that there is potential for some more upsides as we head into the final part or final leg of this year's trading. So what I can see right now is that even with all this sideways trend or base building trend, the FDN PLCI should be able to find ample support around the 1600 to 1620 levels, with a potential push to the 1680 to 1700 level by the end of the year. Incidentally, if you look at the technical side of things, the 1700 level is looking to be a very formidable level for the CI to clear. But if there is a change in the fundamentals and the run up is sustained, then I suppose the run up could see the key index settle around the 1720 to 1750 levels at the end of the year. On the flip side, if you look at the broader market shares, here we're talking about the ACE market and the small cap shares. They have actually made very little headway for much of the year because of the persisting selling by retail players. So there are still very few signs of a reversal for now, and of course that means that the interest in the lower liners are very weak at this point. So as a result of it, the insipid market insipid conditions or following on the lower liners are likely to remain subdued for longer. In terms of valuation and in terms of corporate earnings growth, for the CI constituents, the forecast earnings growth is now estimated at 8.7% for the year. And this is slightly higher than the 7.5% or 7.4% forecast earlier this year, mainly on the back of stronger first half performance. For the AMAS, the earnings growth is lifted to about 10.8%. Previously, it was 10.1%. Also, due to a firmer first half of this year's performance and continuing stable conditions in the second half of this year. For 2025, earnings growth is estimated at 7.1% and 8.5% for the CI and AMAS indices respectively. So looking at the table, you can see that the valuation of the FDMTL CI and AMAS, they are still above the ASEAN average. Okay, even though the we have our performance have outperformed the rest of the Asian Asian our Asian neighbors are. So in all, if we are still trading within the average historical average forward averages of 14 to 16 times. So in all, I would think that it's fair for now, but there is also because the PEs are at the lower end of the historical averages, there is still a little bit more upside to be seen on both the FDN AMAS and FDMTL's stocks. Even though for the most part the fundamentals are already reflected in the price as we speak. Right. So looking at our historical forward averages over the past 5 years, you can see that yeah, we haven't really veered very much from the 5 year average of 17 times. And mind you that the 17 times average have been skewed upwards during the pandemic years uh, by by the low earnings prospect to very high prices of rubber glove stock then. So if you look at the, the the chart on the right, you can see that in terms of PE band, the dark blue line, we are very much within the historical forward averages. So that means that we are on track now. And then that means also very little earnings growth. Sorry, very little upsides left uh, heading into the rest of this year. Okay. So looking at the very quickly, just looking at the chart wise, you can see that if you look at the upward channel, we've consistently been staying above the channel. So for now, it is still looking on the positive side and still on the ascent. So of course, if it breaks the the upper range of the sorry, if it breaks the upper range of the trend line, then it's starting to look a bit more dicey, and you can actually looking at the gap there, I think it's about 7%. So it cannot break it. If it does, then I think we could be seeing a lot of weakness in the CI. But for now, as I said, as explained earlier, conditions look okay, and I would presume that it will continue to stay above the uptrend channel for the time being. Looking at the small caps, it's a little bit more interesting. If you look at the fan formation, so you can see that right now, again, the FDM small cap is at the crossroads again. But since it's headed downwards, there's still a possibility that it could tip lower to the lower line of the fan formation. So for now, it may look to be a very strong support level for now, but upsides may continue to look quite challenging at this point, given that there is lack of buying support for many of these small cap stocks. Okay, so I think my colleague LT will provide you with more technical readings on the CI uh, in his presentation later. But for now, I have reached the end of my presentation for now, and I will pass you on to my colleague Stu Hong. that will present to you some of our stock picks for this quarter. If you have any questions, please leave it for the end of the session. We will try our best to answer your queries. So I'll pass you on to Chu Hong for now. Thank you very much.
Hello, can everyone hear me? Okay, so today I've got two companies to share about. The first one being Hub Seng, the second one is SolarVest. So I'll start with the first one. You guys can see my slides, right? Is it okay? So I'll start with Hub Seng Plantations. A little bit of update on the sector itself. The sector is currently trading at about 15 times and it is still lower at than the pre-pandemic level. Our current assumption is that the CPO prices will still average out about 4,000 for the whole year. And currently, we are seeing that the CPO spot price remains supported at about 4,300 ringgit per ton. We'll see that the price premium to soybean oil may not be sustainable, and the current rally are mainly due to the strengthening of crude oil prices, which is inflicted by the geopolitical conflicts in the Middle East. But that being said, we still believe that there are opportunities for investors to seek out at a time where we see higher volatility in the market, especially for those who favor strong balance sheet with high cash generating capabilities and consistent dividends. So currently, we are seeing that the earnings prospects are getting better for the plantation companies with the easing of labor constraints when compared to last year. We also see that there's been an improvement in terms of the production volume and the fertilizer cost has also come down year on year, and that is expected to actually improve its margin. So a little bit of introduction in on the plantation group itself. Um, Hubson Plantation actually owns 34.9 thousand hectares of planted area in Sabah. It has four palm oil mills and own three biogas plants for internal consumption, mainly to drive down their diesel costs. And all mills are actually RSPO certified. It's got a market cap of 1.4 billion at today's closing price of 1 ringgit 75 cents, and the number of outstanding shares currently stands at 799.7 million. So some of the key merits on HS plants, one of it is the favorable age profile, which is at about 17 years, which we consider it to be quite prime because they're all matured. Most of them are matured. It's got strong balance sheet with no debt, and it's got high NTA value relative to its peers. And the cash per share is about 67 cents, which means that it is in a position to pay consistent dividends moving forward. And the plant is actually planned to replant about 4% of its total planted area. And this is in line very much in with the plantation ministry's recommendation of 4 to 5% of more of a sustainable rate. And and we consider the group valuation currently to be quite cheap after it's retraced back to about 1.7 to about 1.75 level, and the other similar mid-sized plantations are currently trading at about PB ratio of 1.3 times, and their PE is trading at about 16 times PE. But HS Plants is currently trading at about 0.7 times for its PB and 13.5 times for its PE. So our valuation on HS Plant is based on the 0.9 times for the mid-size plantation average pegged to the CY24F, which is CY24 forecast, NTA per share of 2 ringgit 50 cents, and that is an implied upsides of 26.8 times from 26.8% from today's closing at 1 ringgit 75 cents, which we consider it to be quite fair considering The mid-sized planters are currently trading at about 1.3 times NTA, sorry, PB. Um, okay, so on to the financial highlights for the latest quarter, which is the second quarter of CY24. The revenue has actually improved by 8.3% year on year on higher sales volume and CPO prices, which is what we've expected during our last quarterly presentation. And operating profit has similarly jumped 168% to 37.6 million ringgit from 14 million. This is mainly due to lower fertilizer costs, and we expect the fertilizer price to stay mostly level at this price. And the performance was also partly due to the um, fair value adjustments on biological assets. So for this year, the first interim dividends of 1.5 cents was declared, which is the same as last year's. Uh, with the share price at this level, we expect the dividend yield to hover about 5.7%, and overall operating profit improvements should point to a sustained dividend payouts for this year. And our dividend expectations for this year for the whole year is at 10 cents. So on to the outlook. Like what I said just now, our assumptions is still very much capped at about 4,000, mainly as we think that the current strong CPO price may not be sustainable as currently trades at a premium to the soybean oil prices. But we see that the prices should still remain firm on the expected onset of the La Nina effect in the near term, although it's been delayed. Uh, that should still be able to provide some supports to the CPO prices. And also, the share price is generally more receptive to the price movements instead of the volume changes. So we expect some level of support to the share price with CPO still trading on the high side. We also expect the strong export demand from China and India to continue. This is despite the imposition of the export levy of about 20% from India earlier this month uh, for all the edible oil imports, because the oil is still um, remain affordable despite the hikes, and the overall India edible oil demand is still anticipated to grow by 2 to 3% per year moving forward. So there's been also an increasing biodiesel mandate in countries such as Indonesia, which may increase its mandate to about B40 from B35 currently, and the testing on B50 uh, is currently underway. And EU Commission has also proposed to delay the EUDR implementation by 12 months. So some of the key downside risks will still be the expected ample supply of soybean in second half, and that may provide some softening to the CPO prices, despite and also amid the higher FFB production in second half. However, our take is that while CPO prices are expected to remain uncertain, plantation sector still retain its attractiveness, especially with earnings prospects improving due to cheaper fertilizer costs and better operational efficiency following the easing labor constraints. Um, and moving forward, something to look out for will be the budget 2025, which will be this Friday. There might be some potential revisions on CPO windfall tax by the government. This has been discussed uh, very much on the press and by the ministers, and that revision on the CPO windfall tax itself may potentially increase the competitiveness and the operating efficiency of the sector itself. And some of that cost saving could actually be used for replanting activities and to improve its production efficiency moving forward. And there's also been talks about the potential increase in minimum wages policies, uh, And for that, we do not think that it is going to affect the sector itself is not going to be affected by this wage revision that much because most of the harvesting labours are already actually earning higher than the potential new minimum wage rate, which is now very much expected at least 1,700 per month. So onto the CPO futures chart, as you can see that the CPO futures is currently trading at near 4,300, and that is mainly due to the concerns of constrained outputs from La Nina, and also mainly from the geopolitical factors which push the crude oil prices higher now. However, we view the price premium to soybean oil unlikely to be sustainable. Similarly, for the reasons that I have mentioned just now, because then the CPO will be less competitive as compared to soy oil prices. So onto the technical charts, you can see that it's been in the recovery mode since Black Monday, and the price has actually break out from sideways consolidation on the 4th of October 2024, and now it's testing back the support at 1 ringgit 72 cents with the next support at 1 ringgit and 67 cents. And with that, I will now talk about another company, which is SolarVest. So a little bit of update on the company as we see that there might be more and more capacity add-ons coming from the government with the NETR policies on RE transitions uh, and and we think that SolarVest will likely benefit in the longer term on these efforts, either as an EPCC players or as an asset owner. So a little bit of a background on SolarVest. It is the largest pure solar player in terms of market cap, and it is the first one to be listed uh, in Malaysia. Um, they are also the market leader for the solar EPC segment, although there's been an increasing contribution coming from electricity generation now. They also have a proven track record in providing the LSS and rooftop solar installations, and altogether they have installed more than 500 megawatt peak cumulatively in the past. The market that they serve includes large-scale solar, which is LSS, residential, which is the rooftop residential, and CNI, which is also very much rooftops. Currently, they have four LSS assets, two in Manjung, one in Kuala Selangor. These are the LSS 4 assets, and there's one more, which is 1 megawatt in Pokok Sena in Kedah. So some of the key merits on this company, we mainly like SolarVest, mainly due to its proven track record, with the tender book for regional market expansion still remain quite robust at 7.8 gigawatt peak across many ASEAN countries. So the Malaysia's emphasis on the RE recently also remained quite promising as the government aims to escalate the transition to renewable energy with target now sets to be 70% RE by 2050. And we also like SolarVest as they start shifting their reliance away from sole EPCC projects, which is driven um, by their solar assets and CGPP and also the PowerVest program. The LSS4 solar assets of 67.3 megawatt peak has also started solid contribution, which is recurring. And also they have won 90 megawatt of solar assets under CGPP program under some consortium arrangements. And also the group is currently tendering for LSS5 programs with the tender results expected earliest by the end of the year. So overall, we see that the EPCC segment outlook remains promising as a near-term earnings are to be supported by the inflow of CGPP opportunities, while the strengthening ringgit is working to its favor with the solar panel prices are still at its record low. We are on China's oversupply. So our valuation for SolarVest is based on a PE of uh, 30 times for APCC segment, and also an unchanged discounted cash flow valuation for the recurring revenues, which includes the LSS, CGPP, and also the PowerVest. So this results in a target price of 1 ringgit 87 cents, which is a buy recommendation, and it's got an implied upside of about 16.8%. So on its financial highlights, you can see that for for the first quarter of FY25, the profit margin has actually improved to 10.7%, which is the highest compared to last few quarters. This is despite it recording lower revenue, mainly due to better margin from the CNI projects and also the higher electricity sales contribution following the completion of the LSS4 projects. So overall, you can see that the net profit has actually improved quarter on quarter and year on year to about 7.8 million during the quarter. And we expect the PATAMI to continue to grow by 40.9% to 45.5 million in FY 2025. And this is mainly due to the imminent inflow of the CGPP works, which the group is currently targeting to convert a total of about 800 million potential CGPP opportunities. So overall, we see that the group's earnings visibility for EPCC segment still remains very healthy at 469 million as of 31st of July, as compared to 31st of March, which was 242 million. So moving forward, there will still be plenty opportunities which the group could capture. First being the CGPP projects totaling to 800 million, which I said just now, and that is coming from 380 million, 380 megawatt peak, which the group is actively converting at the moment. While the anchoring segment, which is the CNI projects, we still project about 50 million per quarter of revenue. The higher tariff for CGPP projects currently, which our assumptions currently is stands at 25 to 28 cents per kilowatt peak. We also provide better margin compared to the previous LSS4 projects. And the group has tendered for LSS5, and we expect the results to be known by end of year. So onto the technical charts, as you can see that it's actually already break out from the box at the end of January 2024, and it's got a solid support at about 1 ringgit 40 cent zone, and it's recently break out from the downtrend line, and the immediate supports will be at 1 ringgit 54 cents and 1 ringgit 48 cents. And with that, I end my presentation, and I will now pass the presentation to Jesse.
Testing. Good evening, everyone. I would like to introduce CAB Chakaram today, which I just initiated this company recently. So CAB is a farm-to-fork integrated poultry producer, which principally engage in the upstream to downstream business activity of poultry industry. So CAB involves in farming the parent stock day-old chicks and hatching of eggs into day-old chicks, farming, processing, and marketing of broiler chickens, as well as operating and franchising of fast food businesses. The group generated its revenue through integrated poultry division, supermarket division, fast food division, and also drone division. So under the integrated poultry segment, CB is selling day-old broiler chicks, live broiler, and product feeds, slaughtered chicken and chicken cuts, which is under primary processing, and whereas value-added products such as nuggets, sausages, burgers, kebab, sliced barbecue meats, which are under value-added processing segment. So CAB is transforming into a full-fledged integrated food producer, as the group also aim to start commencing its new food processing plant in Libong Tebao by first quarter of next year, and further increase its production capacity to 2,500 metric ton per month. CB is running a total of 14 outlets within the Peninsula Malaysia, which currently present in Kuantan, Kelantan, Penang, Kedah, and Pang, which is the northern part of the Peninsula Malaysia. And the group also targeting to launch another 3 outlets by end of this year, and another 7 to 10 outlets by next year, in a bid to increase its market shares. CAB has been building its relationship with local and fast food brands by supplying processed chicken and value-added products ranging from 6 to 27 years. So the notable clients include Mary Brown, the Chicken Rice Shop, and also Nando's. It is also important to note that CAB is also riding on Mary Brown's growing market share, as it is the sole supplier to the brand. As it is, Mary Brown's offering are seeing improved demand that should further benefit CAB's market position. And the last investment merits will be cooler feed costs. So CAB will pay cheaper feed costs due to the strengthening of Ringgit, as well as the price of corn and soybean meals are trending down. So for financial highlight, CAB's revenue was in a continuous growth during FY21 to FY23. And for net profit was also back to black in FY22 and recorded a higher net profit margin in FY23. And the net loss incurred in FY21 was mainly due to higher feed costs and also shrinking operating profit in integrated poultry segment. So over the past few years, for its borrowing costs, CAB's higher borrowings was mainly due to support its business operation and the acquisition of farm-based food industry, which is its food processing business in 2016. However, we see the debt to equity ratio has been improving since FY22. So to sum up, we like CAB for its business expansion plans that transform CAB to become a full-fledged integrated food player in the next 5 years, as well as growing revenue diversification into the food processing and supermarkets businesses, which means that the company is more on focusing on the downstream business. And lower feed costs and the strengthening ringgit, which helps to ease the group by incurring lesser costs, having long-term customer relationship with a local restaurant and global fast food brand. So for our valuation, based on the key metrics above, we give a buy call on CAB with a 1 ringgit target price based on a 7 times PE ratio, indicating about 56.3% potential upside based on today's closing price. So I will end my presentation, and now I will pass it to Chloe.
Good evening, everyone. Today I'll be presenting Encom Nalex Berhad, a company we have recently initiated coverage on, and also share some of the latest updates regarding the company. First of all, Encom Nalex is a major integrated agricultural and industrial chemicals player in Southeast Asia. Its operations are divided into 5 main segments, namely industrial chemicals, agricultural chemicals, polymer, logistics, and also investment holding and others. The industrial chemical segment involves the manufacturing of ethanol and phosphoric acid, as well as the distribution of industrial chemical products. Notably, it is one of the 2 key ethanol producers in Malaysia. The agricultural chemical segment principally involves the manufacturing, formulation, and sale of agri chemical products. The group holds a unique position as the sole large-scale producer of herbicide active ingredients in Southeast Asia. Active ingredient, or AI in short, is the core chemical compounds within herbicides which act to kill and inhibit growth of unwanted plants. Our buy recommendation is premised on Ancom Nilex's firm growth prospects. With the growing population and rising food demand, there will be an increasing demand for agricultural chemical products, which play an important role in enhancing agricultural productivity and optimizing crop yields. Moreover, paraquat, which is widely used as herbicides, was banned in several countries such as Malaysia, Thailand, and Brazil. The group is poised to penetrate the paraquat replacement market with two of its formulations, where both are identified as close substitutes to paraquat. Currently, Ancom Nilex possesses an extensive portfolio of 6 AIs. The group plans to launch 2 new AIs soon. Both AIs are anticipated to contribute to the group's growth trajectory over the next 3 years. To increase its production capacity for the new AIs, the group has constructed a 70,000 square feet new production plant in Klang, bringing an additional annual capacity of 4,000 tons. Due to the escalating geopolitical tensions, global farmers are seeking alternatives outside China to diversify supply chains. Being the sole herbicide AI producer in Southeast Asia, Ancom Nilex emerges as a key beneficiary of the China Plus One strategy, as it positions itself to be the preferred supplier in the agricultural chemical industry outside of China. Ancom Nilex also intends to broaden its market presence for its AI products by pursuing label registrations for crops with larger hectareages, such as the soybean market in Brazil and the palm oil industry in Indonesia. The Brazilian soybean market is approximately 5 times larger than the sugarcane market, while the Indonesia palm oil industry also surpasses the Malaysian market in scale. Lastly, the usage of herbicides is subjected to stringent regulations by national authorities, so each AI product is required to undergo a rigorous and time-consuming registration process. This prolonged timeline deters new entrants, creating a high barrier to entry for newcomers. The group holds an extensive portfolio of registrations of over 50 products across 40 countries, which also serves as a formidable competitive advantage. Recently, in September, Ancom Nilex announced that it is acquiring a 70% stake in Colorex Sdn Bhd, a specialty chemical company involved in the blending and trading of chemicals, colors, and related products, for 40 million cash. The deal also comes with a profit guarantee, ensuring a minimum PAT of 2.5 million for 2 consecutive years following the acquisition. Colorex is among the top 3 specialty chemical suppliers to the local automotive sector. We expect Colorex product offerings to complement well with the group's existing product portfolio, as the new product mix may consolidate its customer base within the automotive industry. While the immediate financial impact may be modest, we anticipate that the long-term benefits arising from the synergies and expanded market presence will gradually materialize, driving sustainable growth over time. Also in September, the group has proposed a private placement of 96.2 million new ordinary shares to Helm AG at an issue price of 1 ringgit per share, which will further increase Helm AG's stake in addition to the 30 million treasury shares it previously subscribed prior to this exercise. So based on our calculation, Helm AG will emerge as a substantial shareholder with approximately 14% stake in Ancom Nilex upon completion of this placement. We view positively the proposed private placement, as Helm AG's expertise in agricultural and industrial chemicals is expected to complement and strengthen the group's existing core competencies, particularly in its product development capabilities for active ingredients and crop protection formulation, thereby expanding its product portfolio. Furthermore, by leveraging on Helm AG's strong presence in the European market, the group aims to improve its performance in that region through increased market penetration. We anticipate that the positive impact from this placement to only materialize 2 to 3 years later, given the lengthy approval process for agricultural chemical products. On the financial side, Ancom Nalex has posted successive record earnings performance over the past 4 years from FY21 to FY24, while the first quarter 2025 results will be released this Thursday. We believe the agricultural chemicals segment will continue to drive the group's strong earning performance on the back of increasing contributions from both existing and new AIs, which offer higher profit margins. We also expect further cost savings from the group's recent restructuring and consolidation activities. Furthermore, the group aims to leverage on the potential tax benefits for its new AIs following MIDA's recent granting of pioneer status for one of their AIs. We also believe that the proceeds from the private placement earmarked for the repayment of the borrowings will reduce finance costs and improve the group's gearing ratio. With that, we reiterate our buy recommendation on Ancom Nalex with a target price of RM1.33. This is after considering the potential dilutive effect resulting from the resale of treasury shares and the private placement to Helm AG. Our TP is derived from ascribing a target PL of 13 times to our FY25 EPS. Based on today's closing price, there is a potential upside of about 31.7%. So now take a look at the technical chart. While the stock's recent price action may not immediately catch your eye, but there are several indicators that suggest now could be the right moment to enter. First, the stock has been consistently respecting a long-term rising trend line on the weekly chart, which serves as a strong support level. Despite short-term fluctuations, the stock is holding its ground and maintaining an upward trend. Secondly, the MACD indicator, which is circled in red, signals the potential for a bullish momentum shift. The distance between the blue and orange lines is narrowing, suggesting a potential upcoming bullish crossover. This often marks the beginning of a new uptrend in price. In conclusion, the sound technical indicators combined with the group's strong fundamentals present a good opportunity to invest in this stock. So thank you, and this comes to the end of my presentation, and I'll pass the floor to Elke.
All right. Hi. Good afternoon, everyone. Good evening. All right. Thank you for staying with us. Okay. So I will be the last one sharing with on the market outlook technical analysis for fourth quarter 2024. Screenshot. Share screen. Okay. All right. Okay. Let's start with let's start with the disclaimer. Okay. So some of the picks that I'm gonna share some of the stocks right over here today, and they are more towards for education purposes only. All right, it shouldn't be a stock pick. And if you are looking for any making any investment decisions, you should check with your investment advisor or your broker advisors before you do it. Yeah. All right. Okay. So we start with a review on our technical pick for the third quarter 2024. Okay, so in July we have been looking at consumer staples, constructions, transportation, logistics, and we have been talking about very likelihood on strengthening ringgit, which we have witnessed it recently. Okay, especially upon the Fed's interest rate cut. Okay, and also in July, we have been talking about the focus on the interest rate on the trading interest on the budget 2025, which we're gonna see financials to come up on progressive wage and salary increase, and potentially in mega infrastructures and also subsidized removals on this topic. Okay, so out of all this, we have make 4 picks, which are MICB, Angtex, Opstars, and also Focus Points. So let's go through some of this that we have discussed in July. Okay, so let's first we look at consumer staples that we were talking about. Okay, so since July, consumer staples has been heading downwards, and for now we are currently seeing that it's supported at 550 and started to form a rebound. Okay, however, for consumer staples, it could remain in a downtrend formation at this moment until we able to see that the consumer staple index, a consumer product index, able to trade above the 200 moving average line, which is this blue line, above 570 and 580 levels. Okay, yeah. But with the strong support double rejection at 550 levels, that give us some potentials for a rebound as long we see a higher low and then start breaking above 570 and 580. Okay. As for construction wise, we can see construction is forming, is consolidating near the top above the 260 levels. Okay, we can see that the uptrend remains intact and also holding well above 200 moving average lines. Okay, with a reason forming higher low near the 280 levels, we are seeing trading interest is picking up on construction stocks, and that could prolong into a further upward rally in constructions. And as for the third one that we were looking at, which is the transportation and logistic, we are seeing triple rejection from near the 1050 levels for transportation index. Okay, and it is rebounding. So as from what we are seeing right here, although the uptrend remains intact, but it could go into a range bound box formation right over here until we are seeing transportation index able to trade above 1100 levels. Okay, then we might see a further prolonged interest into uh, this sector. Okay. As for the peak that we were talking about, okay, MRCB, we call it at the, we were sharing it at the high, okay, whereby the price has been selling down on the Black Monday. However, it has been forming uptrending and recovering, okay, back to where we were looking at near the 65 levels area. Okay, so from here we given its higher low formations that have formed, and also trading above the 200 moving average, we remain that the upside remains intact with a Bloomberg consensus TP at 71 cents. Okay, so if we look at the technical chart wise, we are seeing that pretty much similar with what we are seeing from technical view, whereby 71 to 72 cents, they are the key resistance for MRCB. As for NTEX wise, we can see after we have shared on 23rd July, NTEX had a spike to 79 cents, 79 cents before the drop all the way down in August, September. Okay, that could be due to profit taking after the by the rally on bonus issue, corporate exercise, and people are profit taking on it. Okay. However, it is coming back towards the consolidation and testing back the resistance of 68 cents, whereby if we are seeing the breakout above 68 cents level right over here, we should see a further upside on NTEX. Meanwhile, for Opstar, we call it at high. Technology was selling down, and upon the breaking below the 1 ringgit 38 cents support, and also 1 ringgit 28 cents last defense line, we are seeing Opstar has been selling down very drastically to below 1 ringgit levels. Okay, so for Opstar wise, we are seeing that the downtrend, it likely to be remains on the downtrend until we are seeing it able to form a base and break above 1 ringgit levels. Meanwhile, for focus points, although it was pressure down on the Black Monday, okay, very quickly we can see the price recovered and back to trades near the 80 cents level. Okay, for focus point, we are seeing that the upside is likely to remain, and it should be testing back to the 86.5 cents resistance level in short term, and given its remain strong fundamental, we might see the buying pressure above this level. Okay, with focus point, we are seeing the Bloomberg consensus TP of 4 ringgit 12 cents level for focus point. Okay, so this will be the summary of for the past 2 quarters what we are seeing, whereby uh, for the past for FFB continue to trade higher while other remains, and also NTEX is perform slightly better than another three for the third quarter 2024. And if we look at the broader market wise, throughout all the sectors, for the sector performance, we are seeing for the third quarter, since July, we are seeing most of the sectors they are performing negatively. Okay, besides financial services, constructions, and also rates. Okay, especially rates on they are the buying momentum were picking up on the interest rate cut. Okay. Yep. So taking cue on the sector perform taking cue from the performance, we might want to continue to ride on the momentum from the financial services, constructions, um, towards the end of the year. Okay, so first we start to look at the FBM KLCI, how FBM KLCI will look like for potentially look like for the last quarter of the year. Okay, so from right now, what we are seeing on FBM KLCI, although FBM KLCI remain trading at an uptrend, okay, but we are seeing the buying momentum has been slowing down, as in we are seeing that the price, the index is registered near 1680 levels, while the MACD is forming a lower high. Okay, and also MACD has been traded below the zero levels, which indicate a potential bearishness to come in. Okay, at this point, we are seeing that the index is still hovering around 1630 to 1650 levels, whereby these levels is the key support area, the support cluster that we are looking at. And as long we don't see a firm break below this level, to be firmly staying below 1630, then we might see, given the seasonally behavior during the year end, we might see the FBM KSI try to rebound and test back to the 1680 levels. So at this point, as long the index stay above 1630 levels, I would say that the FEM KSI is likely to trade in a range bound between 1630 to 1680 rather than a potential downtrend. As for FEM small cap, what we are seeing FEM small cap is it has been steadily staying below the 20 days moving average and also has crossed below the 200 days moving average over here. Okay, in short term view wise, on the selling down on the Black Monday, we are seeing that the small cap index has moved into more towards a downtrend formations. Okay, but one good thing that we are seeing right over here, despite that we are seeing a lower low forming in the mid September. Okay, we are seeing a higher low forming on the MACD. This bullish divergence actually telling us that the momentum on the small cap index is actually diminishing, whereby we might see some buying pressure, and also this level serve as a very strong support for our small cap index. Okay, and also similarly to FEMKLCI index, seasonally small cap index, it will perform better in the last quarter of the year, whereby we might see some pickup and rebounds on small cap index towards the 18 above the 1800 levels. Okay, of course, the very first level that we will have to look at it will be at somewhere around here 17800 levels, but it should be quite easy to overtake. And next we will be looking at 18500 to 18600 levels for FBM small cap. Okay, as on the other hand, we are looking at Ringgit has been strengthening. Okay, and in October, it is retracing. It is retracing on the reasons stronger Ringgit. Okay, so however, we are seeing that this is going on a very strong strong trend on our strengthening Ringgit, and then we expect the Ringgit to continue to stay strong amidst the anticipation of another 2 rate cut in by US Federal Reserve. Okay, so here comes to our the last quarter of 2024 trading ideas. Okay, so for this last quarter, my another 4 stocks that I'm looking at very closely for this quarter. The very first one, it will be HSS Engineers. Okay, which we have mentioned about it during our second quarter, which it is an industrial engineering company. Okay, and the second one will be Jayatiasa, which is a plantation. The third one will be Mr. DIY on consumer product, while the last one will be OCK on telecommunication sector. Okay, so for HSSEB on the closing today is at 1 ringgit and 10 cents, and from what we are seeing right over here is we are seeing HSS Engineer is forming a potential support near the 1 ringgit levels, and the selling from 1 ringgit 34 cents has been diminishing. Okay, yeah. So even though this 1 ringgit to 1 ringgit 03 levels is the low for the Black Monday, and so far for the past 2 months we are seeing they are more towards accumulations and buying near the level rather than breaking down and continue to pressure lower to the 90 cents level. Okay, hence we are seeing there is a potential for HSS Engineer to trade higher from here. Okay, for bottom rebounds, in the anticipation of more clarity from the government on budget 2025 for our mega infrastructures, and also potentially revival, and also talking about the data center projects again, which HSS Engineer they would be benefited. The second one will be Jayatiasa. Jayatiasa closed at 1 ringgit 70 cents today. And technically, what we are seeing on Jayatiasa is we are seeing Jayatiasa has formed a potential bottoming formation from 1 ringgit to 1 ringgit 20 cents level over here. Okay, so given that's what Chu Hong was sharing earlier, given plantations might benefited from the La Nina effect, which it might affect the harvesting, and also the strong consumption and also export of the palm. Okay, we might see Jayatiasa to right on this for bottoming formations and also break out above 4 ringgit 20 cents level to trade higher towards the immediate resistance at 1 ringgit 35 cents, or even the year high at 1 ringgit 50 cents level. Okay, but for plantation stocks, we have to be very cautious, whereby given our stronger ringgit right now, it might reduce the attractiveness of and also the competitiveness of our local palm oil, and also amidst reasons lower export tax implemented by Indonesia. However, for palm oil wise, we can see that seasonally October until December, they are usually performing better based on the heat map, the seasonal heat map. Okay, so given that the palm price has been traded break out from the range of 3,600 levels to 4,100 levels to trade potentially right now at 4,000 levels to 4,400 levels, we might see Jayatiasa able to post a good and improve results in the in coming months. Okay, yep. And the third one will be Mr. DIY. Okay, actually, Mr. DIY is the only stocks that's on that I pick for that is uptrending. Okay, Mr. DIY is trading at 2 ringgit 15 cents, and we have been seeing Mr. DIY has been trending higher since April, since the breakout of 1 ringgit 60 cents level over here. Okay, that happened in somewhere around in May. Okay, since then, Mr. DIY has been trading higher and has been testing on 2 ringgit 20 cents resistance level. Okay, given it has been consolidated and formed the block around this level. Okay, for those who are trying to buy on bargain hunting, you might want to try to buy some if you're able to see the Mr. DIY the price drop to 2 ringgit, or for those who are trading on momentum, you can monitor closely for Mr. DIY for the breakout above 2 ringgit 20 cents level with a potentials the next technical resistance level at 2 ringgit 50 cents. And why Mr. DIY is mainly I like it for its uptrend with an increasing volume, and also um, given that we are witnessing a stronger ringgit, Mr. DIY could benefit from it, given many of their products are from China. And also with an expansion of the KKV stores, currently they have 3 stores right now, which is selling on the lifestyle retail chain from China. They are enjoying a better profit margin, which the revenue is also 3 times higher from its own store. Okay, so give with the seasonally FBM KSA to perform better by the year end, we might see Mr. DIY able to hop on the current uptrend and continue trend higher until the end of the year. Okay, last but not least, we will be looking at OCK. Okay, OCK has been selling down since mid of July, and the selling has been picked up on a was on a lower than expectations result on their due to their Myanmar issue, and also and one-off impairment losses. Okay. However, we are seeing that OCK is currently come to a critical strong support of 45 cents, and some buying volume has been picking up, which we are seeing that as a sign of potential accumulations at the key support level. Also, for OCK wise, we might see a better performing result if we are seeing that they might get a new order from second 5G network rollout, which we are seeing recently. There are a lot of things that it might come in during the last quarter of the year. Okay, so with that, if that really materialize, and that should give a positive a better view, and also positive sentiments towards OCK for a potential rebound back to the very first resistance level at 454 to 57 cents area, or riding on the better performance wise if we are seeing more catalysts such as Jandela Phase 2, or even its huge tender book of 920 millions towards 65 cents level. Okay, so that would be wrap up the 4 stocks that I will be monitoring very closely for the last quarter of the year. Okay, and that should mark the end of my section for today on the 4th quarter of the stock pick, and also our 4th quarter market outlook section today. All right. Thank you very much for staying with us until the end of the section. And if you have any questions, do feel free to share in the comment, and we will attend to it. Meanwhile, while we are waiting to see if there's any questions, let me do a very quick advertisements to those who attend to our session. Is currently our company is running on a campaign whereby for new account opening, okay, for new account opening, and those who traded at least one trade, there will be a chance to win an iPhone 16, and also every month we have 5 lucky draws that gonna happen during our monthly traders talk on first Monday lunch hour. All right. Okay. So so far I don't see there's any questions. Yeah, hold on. Okay. So we are seeing there's one asking about WCT. Let's look at WCT. Okay. 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 So for WCT, we what we are seeing on WCT right over here is after the surge on WCT until August, okay, what we are seeing that WCT has been trending lower uh, until it found a support near 90 cents level. Okay, so if we look at the MACD right over here, we are seeing the selling down on WCT has been slowing down, whereby we are seeing a lower low over here, but a higher low on a MACD. So this is a bullish divergence that we are looking at for WCT, and that's actually telling us that it's finding a support around here at 90 cents. Okay, so if you if you're looking to buy into WCT, okay, this is actually a level whereby you can consider to accumulate and buy some, okay, as it possess a low risk, high rewards potentials, whereby the immediate resistance it is at about 20 cents higher from the current level, okay, with the stop loss below at 88 below 88 cents. All right. Okay. So for the outlook for the WCT wise, I'm seeing that it stands a good chance for a rebound and test back to Ringgit oh 05 to Ringgit oh 08 levels, but it could be likely to trade in such a range bound until we see a very strong surge, potentially with any catalyst stories above the Ringgit 10 cents level, and from that then only we will be looking at Ringgit 30 cents level for WCT. Okay, yep. So, all right. So that will be for WCT. Okay. Uh, we also seeing Hume Industry and also Icon. Okay, so for Hume Cement wise, okay, for Hume Cement, we are seeing Hume Cement is trading on an uptrend. Okay, we can see that Hume Cement has been, it touched 200 moving average and started to rebound for starting in September. Okay, this come in line with the trading interest pickup on construction stocks. Okay, which Hume Cement is what is also is a building materials company. Okay, as the price is holding well along with the 20 days moving range, we are seeing a potential trading higher, and also the momentum might come in at the breakout above 3.44 cents towards the next level of 4 ringgit levels, which is 52 weeks high. Okay, so one thing, if you are trading for Hume Cement wise, this is a counter with lower liquidity, whereby you will see patterns like the price can continue go up every day, go up bit by bit, and some days it might just spike up. Okay, so if you're trading on Hume Cement, you have to hold on to it, especially if you are seeing a continuous buying momentum after the breakouts, whereby it might rewards you for being patient with them. Okay. And last but not least, we ask for Icon Offshore wise. Okay, for Icon Offshore, um, if we look at Icon Offshore, we are seeing a slowing down in the momentum. Why is it so? Is because uh, from the MACD, we are seeing a bearish divergence happening. Okay, with higher high on the share price. Okay, to 1 ringgit 30 cents, but a lower high on the MACD. Okay, so despite that, Icon Offshore has broke above 1 ringgit 20 cents level, which is a key resistance level, as what we can see over here. The price unable to maintain above the levels, but decisively to trade lower. Okay, even on the rebound on the October 2nd. Okay, October 2nd, we are not seeing that the share price able to re-break and stay above 1 ringgit 20 cents. Okay, given with this formation, what we are seeing is Icon Offshore is likely to remain capped at 1 ringgit 20 cents level, and any strong resistance and rejection from 1 ringgit 20 cents level, it might lead to a potential selling pressure towards the 200 days moving average. Okay, last from the floor, okay, we have another one which is SNS. Okay, SNS network. Okay, SNS network. We can see SNS network has been rallying very strongly on data center thematic. Okay, during the first half of the year, and if we run Fibonacci over here, we can see that SNS network has retraced to 50% of the rally. Okay, so this also come in line with the 200 days moving average, whereby we might see SNS network to trade sideways over here. Okay, for one who are interested to invest into SNS, this level, it could be a key support level for SNS network. Okay, but until we are seeing an increasing pickup in the volume, otherwise it might just go on sideways over here for SNS network. Okay, Iris is asking about PBB. It's not public. Okay, PBB, I would assume is public bank. Okay. All right. For public bank wise, we are seeing the recent sell down on public bank due to the news of LPI acquisitions, and also the offer for sale from the family. Okay, from a Pay family. Okay, so we had seen a knee-jerk reactions whereby it's immediately it sold out to 200 moving average and then started to rebound from 200 moving average at near the 4 ringgit 30 cents level. Okay, but we are seeing that the sentiment for public bank remains, as we can see that within 2 days immediately we are seeing the rebound and also cover the gap. Okay, rebound and covering the gap over here with this week the rebound in the public bank. Okay, no doubt we are seeing a short-term bearishness in the technically. Okay, but given the sharp rebound rejection from 4 ringgit 30 cents and also 200 moving average levels, we might expect the buying continue to pick up and prolong uh, to trade above 4 ringgit 50 cents levels for public bank. Okay, in comparison to other banks, if we look at like Maybank, okay, like Maybank, we are seeing Maybank is trading on an uptrend. Okay, still uptrend and it already start moving above the moving average. CMB, okay, CMB also we can see that it has retraced and also start rebounding above the moving average. Okay, and also MACD is also cutting out, indicating a improving in the momentum. Okay, that's actually telling us that the interest on the financial sectors or the banks, they are actually coming back and also it's getting stronger. Hence, for public bank, although technically we are seeing that on the sharp retracements or on the corporate actions, okay, there could stands a good chances that there might be some buggy huntings to pick up on the laggards in public bank compared to a better performance in the Maybank and also CIMB. Okay, all right. So I'm gonna take the very last one, which is Mat Bichara is asking about energy stocks. Okay, so if we look at energy-wise, Bursa Energy Index. Okay, we can see Bursa Energy Index is capped at is still forming a topish pattern, and also recent rebounds also capped below 200 moving average and start coming back down. Okay, and if we are looking at hibiscus wise, we are seeing hibiscus, although the rebound on the increasing tensions of the Middle East war fam, okay, the rebound on hibiscus is also unable to trade above the moving average, but it started to come back lower to stay on a downtrend formations. So at this moment, I would rather to focus on those who that are trending in trend, rather than to look into the energy stocks. Okay, especially if we look into Brent crude oil. If we look into Brent crude oil, Brent oils continue to remain still on a downtrend formations, and potentially it gonna retest the key resistance around here at 70 bucks. Okay. So for oil outlook wise, we need to see a really concrete improvement in the economy environment and also the sentiment. Otherwise, oil demand might remain weak, and also um, oil stock could remain to avoid oil stocks at this moment. All right. Okay. So that will mark the end of our session for today. Okay. Thank you very much for staying with us and supporting us. And we wish you have a very great quarter ahead, and have fun with Budget 2025 on Friday. Thank you. Bye bye.